Hello, and thank you for joining us today. My name is Marc Montini. My company is the Montini and Company Tax Advisory Group, and this is our fourth installment of our tax and retirement planning webinar series. Today's topic is understanding annuities. Now, if you've ever explored the use of an annuity for yourself, you've probably found a lot of negativity that's out there. And I don't know if that's necessarily fair, and I even maybe borderline on irresponsible. Yes, annuities can be complex, and there are certain annuities that have a lot of fees in there. But that's why we want to try to educate you and help you make the right choice as to what annuity best fits your needs. You are here in this webinar to learn, and I'm not here to sell you anything. I'm just here to help you to make a more educated decision. I'm a licensed fiduciary. What that means is I have a legal obligation that any recommendation I make for my clients, that recommendation is being made in their best interest. But I'm also an independent advisor, which gives me the benefit of being able to pick and choose virtually any investment vehicle that I want to use. Annuities are highly regulated. They are insurance products, which means they are regulated by your state's Department of Insurance. In a previous position that I held, I was involved in the creation of some particular annuities, and I saw firsthand the amount of regulation that goes in. So I don't believe there are bad annuities out there. I don't think this Department of Insurance is going to allow that. But I do believe there can be bad uses of annuities. So we want to tread lightly. One of the main reasons we would use an annuity is for its safety. And here, Warren Buffett said it the best: don't lose money. And if you, in the second rule is, don't forget the first rule. Okay. And this is going to be one of the main reasons why I'm going to utilize an annuity for a portion of somebody's portfolio, is to build that base of safety. Now, there's a lot of different annuities that are out there, okay? And I'm going to talk about a few of them in a little bit. But there are some tax benefits you get by using an annuity. An annuity grows tax deferred. So just like an IRA grows tax deferred, you don't pay any money until you start taking withdrawals out. You're paying any tax until you start taking withdrawals out. So for your non-qualified money, money that has not been taxed yet, your savings account, your proceeds you got from when you downsized your home, that money could go into an annuity, and you can bypass capital gains taxes and dividend income and defer the taxes on that money until you start taking withdrawals out. Now, why use an annuity? I always want to make sure when we're picking particular investment vehicles that we are investing that money with a real purpose, that we have a very clear-cut goal as to what that particular investment vehicle is doing for us. We want to make sure that we're finding balance between safety that often you can get with most annuities out there and guarantees, but you also have to have plenty of sufficient other liquid assets on hand. So this is why I always say we just want to use an annuity for a portion of the funds, right? The annuity landscape is vast. So please don't try to do this on your own. Let me help you to find an annuity that may best fit your goals for a portion of your overall portfolio. Now, annuitization and immediate annuities. This is one part. These are certain types of annuities. These are income-based annuities, and these particular annuities are going to work very similar to a pension, in that you can get a guaranteed stream of income based on the parameters that you set. It can be guaranteed for the rest of your life, or it could be guaranteed for your life with a period certain, meaning you could do like life with 10 years certain. If you were to pass away after the second year, there'd be 8 more years worth of payments to go to your beneficiaries. Or if you just chose life only, if you died in the second year, that's it. And that's the negative side of these particular kind of annuities, is once you start it, you can't stop it, and that's it. Now, we could have a very clear goal as to why we want this income guaranteed for the rest of our life. But for the most part, the certain nature of these particular annuities and the inability to get out once we start typically would be a negative aspect of these things. So you'd want to be really careful if you're going to choose an immediate annuity. you can get a multi-year guaranteed annuity, right? These are going to operate very similar to a CD in that you're going to get a fixed rate that's guaranteed for a certain period of time, 3 years, 5 years, 7 years. And then after that term, your fixed rate's going to renew. Now, one of the positive things that's happened here as of late, we've had interest rates rise in order to offset inflation. Well, with higher interest rates, we're seeing higher fixed rates coming out on certain annuities. So this has worked out well as the Federal Reserve is trying to fight inflation. But these annuities, much like any other, are going to have limited liquidity, right? You're only going to be able to take out 10% each year for income or for whatever reason you want. If you take out more than 10%, they're going to hit us with a penalty. So again, we have to find that balance between safety and guarantees and liquidity. The negative is if interest rates go back down, you're typically going to see these fixed rates go down as well. Index annuities, fixed index annuities are very, very popular today. How a fixed index annuity is going to work is your return is going to be based on an outside stock market index versus getting a declared rate from the insurance company. So what this does for you is it gives you the upside potential of the market without any of the risk. Okay, the risk is limited liquidity, but you don't have any risk in the index. If the stock market index goes up, you lock in that gain. If the stock market index goes down, you make zero and you don't lose a dime. Again, like other annuities out there, we have limited liquidity. You only get 10% each year. Now, the other part that makes these types of annuities very complex is that you don't necessarily always get 100% of the particular index. Oftentimes, the insurance company has to utilize what's called a modifier in order to give us some upside potential with no downside risk. And I think that's what makes these things complex, is when you really dig deep into how these things work and you look at it right here up close. It may not make a whole lot of sense. You just see like this Abraham Lincoln. You just see a bunch of little Abraham Lincolns. But when you pull it back, oh, okay, I see what they're trying to achieve, and it makes a little bit more sense. But again, this is where these things can become complex and where a lot of the criticisms could potentially come from. And when we're talking about index modifiers, we have caps. Okay, you're going to get a certain index up to a cap rate, 4%, 3%, 8%, whatever, based on the current interest rate environment is. They could use averaging, right? Averaging, when you take an average of something, you're typically going to reduce that amount by 50%. So you want to pay attention to that. We have participation rates. Now, these participation rates can work in your favor sometimes. It depends on what particular index is being used. The S&P 500 is a very popular index, but the problem is what the insurance company is doing is they're buying a call option on that particular index. Well, if you think the market's going to go up, you buy a call option. If you think markets are going to go down, you're going to buy a put option. So the insurance company is simply buying a call option on a particular index. Well, because the S&P 500 is so widely used, the cost of that particular call option can be prohibitively expensive. So that's where you're going to see a cap of 4% or a fee or a participation rate of 50%, depending on, again, on the particular insurance company that you're looking at. But if we're not using some of these widely held indexes, maybe we're using a smaller index by a bank, say Barclays, because those particular indexes aren't as widely used, your participation rate can actually be 200% of the particular index. So it could work in your favor. Again, this is where the complexity of these things really come into play. So don't try to do this on your own. Let somebody like me, a licensed fiduciary, help you to make the right choice. There's a lot of different riders that you'll typically see on particular annuities. You have life and death benefit riders. The life benefits are going to be income-based riders. So you may see or hear advertisements of getting a 15% bonus and 10 or 12% return, right? Yeah, you do get that, but that's only for your income base, which is going to be utilized for what your future income is going to look like. That's not your cash value, right? Your cash value is never going to surpass what that income base is going to do. So you, again, make sure that if we're going to purchase an annuity with, say, a living benefit, like an income benefit, that we know exactly why we're doing that and what that income benefit's going to look like in the future. You could also find that that income benefit may far exceed what your actual income needs are. And what that simply is going to do is cause you to pay more taxes on income you may not want or need. So again, we want to make sure that when you're making a decision like this for a portion of your portfolio, that it's fitting in with exactly what that goal is. The death benefits that some of these annuities offer, do not confuse that with life insurance. Okay, it is not a life insurance tax-free death benefit. These are simply guarantees that the insurance company is going to make on growth that you get paid out when you pass away. So it's not going to do you any good, but your beneficiaries are going to love it. So this could be something that we look at if that's a goal, if wealth transfer is a goal that we're trying to achieve. We want to make sure that we pay very close attention to the additional fees that come with these particular riders. They don't come typically for free. Most of them are going to be charged against the cash value of the annuity. So we have to pay attention to that. So where do you go from here? Well, number one, again, find balance between safety and liquidity. We want to make sure that if we're going to use the annuity, that maybe we're using it because we want that safety. And that's great. That can be the foundation of your overall portfolio. And then everything else can be built upon that, guaranteed against stock market losses that you're getting with the annuity. Maybe we use another vehicle in addition to that, that's going to limit your losses to be no greater than 10%. Maybe we use another investment vehicle that has other ways of mitigating risk. We also want to make sure that if we're going to use an annuity, that we're not paying additional fees to tax defer a vehicle that's already being tax deferred, like an IRA would be. Okay, that's a big common place for criticism for annuities. Have clear-cut goals. Why are we doing this? Why are you putting your money into this thing? Is it income? Great. Is it safety? Is it growth? Or is it a combination of the two? I know I want my money safe, but I also still need to grow the asset. Okay, some annuities can do that for you. Annuities should be viewed as an asset class, like stocks an asset class, bonds are an asset class, real estate is an asset class. This is an annuity as an asset class is simply another way to add additional diversification to your overall portfolio. And so now we're not only diversifying by asset, but we're diversifying by asset class. Okay, and by doing that, over the long haul, we can generate a more stable and consistent return over time. Lastly here, we want to make sure you're working with a licensed fiduciary like me to help you navigate this vast world of annuities. Because trust me, there is a ton of them out there, and they all are going to do different things for different reasons. Now, if you like this webinar, okay, keep your education going. Right? We teach a full 1-hour tax and retirement planning class every Thursday night at 6 p.m. You have to register for that class, but you can do so at phoenixsocialsecurityclass.com. That's phoenixsocialsecurityclass.com. Lastly, if you like this, if this was somewhat educational for you, share it with your friends and family. Okay. Retirement's a lot more fun when you can do it with friends and family. And with that, thank you very much.